Hello, my name is Roberta Rokas. I'm a Managing Director and Wealth Planner here at Hugh Johnson Advisors. As we get closer to year end, we'd like to get you thinking about your income tax planning. While we don't give tax advice here at HJA, we would like to give you some ideas to think about and then consult with your CPA, reach out and talk to us as well. So we'll start with the easy stuff, of course, retirement plan contributions. As you're getting towards the end of the year, it's a good idea to make sure that you're going to be able to maximize your deferrals to your 401k if that's something that you've decided to do. In addition to that, you also want to make sure that you are completely taking advantage of any match that your employer is giving you on your 401k. So reach out to your HR director for a little bit of help with that, or your HR representative, I should say. You can also reach out to us and we can have a conversation with you. For 2018, the limit that you can defer is $18,500. If you're over 50, you can actually do a little bit better than that. It's $24,500. In addition to the retirement plan, you may have the potential to also do an IRA contribution, either to a traditional or to a Roth. The limits would be $5,500 for most people, $6,500 for those over 50. There are some additional rules around how much income you can make and still do a Roth contribution, or how much of your traditional contribution would be deductible. So more complicated than we want to go into here, but certainly a good thing for you to be thinking about and talking with your tax people about. One other thing that we look at year end are your capital gains and losses. So take a look at your most recent taxable accounts and look to see what realized gains have been taken year to date. And when I say realized gains, those are going to be sales that have actually taken place already. Get a tally on that and then take a look at any losses you might have in your taxable accounts that you could realize and use to offset some of those gains. Once you have those numbers in mind, again, reach out to your tax professionals, reach out to us. Let's have a conversation about it. We'd love to help you with that. One other thing that we consider as we get closer to year end are our gifts to charity. So certainly the simplest way to take care of that is to write them a check and drop it in the mail, and they will absolutely appreciate that if you were to be so generous. One thing that we'd ask you to consider, though, is the use of appreciated stock rather than simply writing a check. And when I say appreciated stock, this is potentially an asset that you paid, say, $10 for, and currently it's worth $100. So if you were to sell that, you would potentially have a capital gains tax on that difference, that $90 between the 10 and the 100. However, if you simply gave that asset to charity, they would have the full benefit of it because they're not going to pay any tax. So it's as good from their perspective, maybe a little better from your perspective, and certainly worth consideration. One thing to keep in mind as we get closer to year end is that this is something a lot of people are going to be trying to do. So if we look at this the last week of the year, it will be very difficult to get that taken care of. So let's talk about that sooner rather than later, and we can help you with the logistics of that. One thing that you also want to consider for your charitable contributions is that the standard deduction is so much higher this year. You want to look at, will you get an additional benefit from those gifts? Some people are considering bunching their contributions, which is to say, this year I'll give twice as much, maybe next year I won't do anything, and then the following year I'll start that process over again. If that doesn't appeal to you for whatever reason, there are some other alternatives that you can think about. For instance, a donor-advised fund. And in that instance, what you would do is you would make one large contribution to a donor-advised fund that you would establish, and then over time, you can distribute that out to the charities of your choice. Donor-advised funds you can generally find through a community foundation. Different custodians offer them. We can work with you to find a way to get that taken care of, so just give us a call. One other charity that you might be thinking about this time of year are your children and others that you give money to. So annual exclusion gifts are the amount you can give without having to worry too much about the gift tax implications. This year you can give $15,000 to anyone without having a concern, or $30,000 if you were to elect to split gifts with your spouse. One great thing about the exclusion gifts is that it not only removes that current $15,000 from your estate, but also all of the future appreciation. So really can be a meaningful impact over time. If you are considering any gifts that are earmarked for education, you may want to contemplate using a 529 plan. And what that is, there are lots of different 529 plans offered by different states, and we can work with you to look at what the investment options are within each one, what the expenses are, and what other benefits might be available as a result of that. For instance, the New York State 529 plan allows you to take a deduction on your New York State return on an annual basis for contributions to that New York plan. And again, lots more details that we can't go into right now, but just something to think about. And then finally, for our friends that are over age 70 and a half, one thing that we really like to make sure is taken care of this time of year is your required minimum distribution, or your RMD as we tend to call them. So reach out to your custodian, your investment advisor, make sure that you have taken the correct amount of money. We don't want to run into any of those penalties that are so onerous. And if you find that you have not yet taken your required minimum distribution, one option that you have in addition to simply taking it is to consider a qualified charitable distribution. And in that situation, you would reach out to that custodian and say, rather than sending the money to me, send it directly to this charity of my choice. In that situation, you aren't realizing that income yourself. You're also not realizing the deduction. So a little complicated, and definitely something that you want to talk to your tax advisor about before you do, but a great thing to just think about. So remember, these are all general ideas, and we don't want you to implement any of them without consulting with us, consulting very importantly with your tax advisor, because everyone's situation is different. But it's good to spark that conversation and just start thinking about that. So thank you so much for listening, and we look forward to hearing from you.